Hi, everybody. This is Peter Schiff. It is Friday, August 16th, 2013. We had a lot of action in the markets this week, quite a bit of volatility. The Dow Jones dropped about 350 points, one of the worst weeks all year. It was over a 2% decline, similar decline in the NASDAQ. On the other hand, gold had one of its best weeks of the year. Gold was up better than 50 bucks, maybe 55, 60. It was up more than 4% on the week. Silver shined even brighter. Silver climbed by better than $2.50 an ounce. That was a 13% move in 1 week. The dollar index was off about a full percent, weaker against the euro and the yen, as well as other currencies like the Aussie dollar. If you look at the bond market, big story there. Yields on the 10-year government bond, treasuries, rose to 2.83, and on the 30-year, the yields rose to 3.86. Now, these are still historically low yields, but they're the highest they've been in 2 years. And this is going to be very problematic. But, even with all the weakness in the stock market, oil still managed to gain almost another buck. We closed maybe 20 cents shy of $108 a barrel. Look, none of this is good news if you're a bull, if you're optimistic on the U.S. economy. You have U.S. stocks down, U.S. bonds down, the dollar down, gold and oil up, right? That is not a pretty picture. Certainly if you're Ben Bernanke and you're actually thinking about tapering, how are you going to do that in light of what's going on? Now, I don't think Ben Bernanke, I've said this many times, I don't think he's thinking about tapering. I think he's talking about tapering because he knows he can't actually do it, and he's looking for an excuse not to do it, but he can't come out and say that. Now, does that mean it's impossible that maybe he won't announce some trivial amount of tapering to try to save face if he thinks he has to do that? I think he might, but I think that's very dangerous because the Fed is going to have to do an about face because any tapering, remember, sows the seeds of more QE, because the tapering means we're right back in recession. In fact, just anticipating tapering could be all it takes to put us back in recession. So I think it's very dangerous for Ben Bernanke to risk showing his hand and showing really how impotent the Fed is when it comes to more monetary stimulus. I think the less risky course for the Fed, if you're just trying to delay the inevitable as long as possible, right? You don't care about the country, is to never taper and just pretend that tapering is around the corner. But for when something came up and now you can't do it just yet, but just wait, we're going to do it. I think that road is going to be less difficult for the Fed, even though a lot of people are going to begin to call the Fed's bluff as September goes by, October, November, December, and there's no taper. And of course, pretty soon Ben Bernanke is out of Dodge, so it's not even going to be his problem anyway. And I'm sure he'd just assume punt this ball away and try to run it down the field himself. But let's look at what else happened this week of significance. First of all, look at the earnings. We got earnings from Macy's and from Walmart, right? Very different types of stores, but they both had the same story. Their sales missed Wall Street estimates. Their customers aren't shopping as much. They're not buying apparel or whatever it is they're selling there. And so their stock prices were down. But if the economy is really getting better, why aren't you seeing that at these retailers? After all, we know that earnings were very strong for MasterCard and Visa. We got those a couple of weeks ago, right? People are ringing up their credit cards. They're maxing them out, right? Credit card usage is way up. But obviously, they're not using those credit cards at Macy's. They're not maybe using them as much as Walmart either. So where are they using them? See, I think they're using them at the grocery store. I think they're using them at the gas station. You see, a lot of people that used to have full-time jobs, now they just have part-time jobs. They can't make ends meet. So now they have to borrow money to buy the necessities that they used to be able to afford. So the fact that people are using more credit cards but buying less of what they want because they have to buy more of what they need at higher prices, this is what's going on. This is bad news for the economy. And it wasn't just the retailers. Cisco came out during the week with bad numbers. Revenues missed. Stock was down. More importantly, they're eliminating 5% of their workforce. 4,000 people going to be laid off. Now, these are good jobs, right? If you got a job at Cisco, you're making some nice money. Now, what's going to happen? How are we going to replace these jobs? Well, sure, next time we get the jobs report, in that report, I guess will be a bunch of these Cisco jobs, but it's okay because maybe we'll create 5,000 or 6,000 part-time fast food restaurant jobs, right? To make up for these good, high-paying, full-time jobs that we lost over at Cisco. So you got weak sales across the board. You've got more layoffs coming. Yeah, we did get a weekly jobs number this week that was the lowest first-time claim, I think, since at some point in 07. But first of all, I'm sure they're going to revise this number upwards next week. I mean, they always revise the previous month upwards when it comes to these weekly claims numbers. But I would look at the bigger picture and don't get sidetracked by what might be an aberration in a number, because I'm looking for these unemployment numbers to start moving back up. Also look at the housing start numbers we got today, right? It was a little bit better than anticipated, but that's only if you look at the headline number. Look beneath the surface, and the beat was because of multifamily. If you look at single-family home starts, they were way down. They're at the lowest level in almost a year. Again, why is this happening? Because people with part-time jobs can't afford a full-time mortgage, even at 4.5%, right? Even at an artificially low rate. So there is more demand for rental units for people who have less income because they have part-time jobs or no job at all, or they're moving in and they have roommates or stuff like that. So this shows you that the housing market is already weakening. The home building stocks have been among the weakest stocks. They actually rallied back a little bit yesterday, and some of them rallied today. Maybe just a short-term bounce. I think the sector looks like it's got no place to go at this point but down. But obviously, the housing recovery is already tapering before the Fed is tapered. And remember, the taper talk is all predicated on a recovery that is based on a strong housing market, that's based on a strong stock market. The wealth effect, well, it's already working in reverse. It's the wealth that's tapering, right? People are losing that. And in fact, if you look at the housing market, I read that 60% of the home buyers of single-family homes, 60% are paying all cash. All cash. Now, what does that mean? That means these are investors, or maybe we should call them speculators who are buying, not average Americans who are buying homes to live in, because the average American doesn't have 100, 200, 300 grand burning a hole in his pocket that he's going to buy a house, all cash. These are investors, speculators. And just because the speculator pays all cash doesn't mean he didn't borrow the money. He just didn't have to get a home mortgage. You see, the more sophisticated players on Wall Street, they can get their money from the Fed. They can get their money first. They can borrow a bunch of money and then go on a shopping spree. So a lot of that money has still been borrowed. It just hasn't been borrowed through a traditional mortgage, which is the way a real buyer would get his financing. But what does that mean, again, about this housing recovery? It's phony. It's speculative. And I think it's already starting to roll over. And think about this. What's going to happen when all these private investors, these hedge funds, when they want to unload? Who's left? There's nobody to buy. The real buyers, they couldn't even afford to buy houses before the prices went up. How are they going to afford to pay the inflated prices that the hedge funds got in on? In addition, with interest rates rising and mortgage rates rising, it's even more problematic. So when these speculators turn around and sell, they're going to take some big losses. And you know what? They're used to it. I mean, if you buy a stock, and it goes down 20%, 30%, and you got to cut your losses and run, that's no big deal. Speculators know that sometimes you have to take a loss, but when this happens in the real estate market, because remember, they don't have a mortgage, but they might have debt, but they start to unload these properties, these prices could get killed. The Fed has got to know that this whole house of cards recovery is collapsing, and the Fed is sitting there watching the whole thing, knowing that they're expected to taper based on the recovery in housing that they said was real. Remember, even Ben Bernanke said he wasn't worried about rising interest rates and rising mortgage rates because he said he expected home prices to keep rising. And it was the rising home prices that were going to give people confidence and purchasing power. Well, how are home prices going to rise when the speculators don't buy anymore, when the speculators start selling their properties. So he's wrong again, as he usually is. Also, we got numbers even today on the University of Michigan consumer confidence. Now, last month, it was like the highest it's been in a few years. It was 85.1. And the optimists on Wall Street were looking for an even better number this time. They were looking for 85.5. Instead, that number came out at 85 even. 85 even. I mean, not 85, 80 even. 80. So a big drop from last month. So consumers are already becoming less confident. And of course, they were overconfident before, right? They shouldn't have been as confident as they were because they were buying all the hype in the media. They were hearing about this recovery. Maybe they weren't experiencing it, but they were hearing about it and they thought, oh, maybe it's coming. Maybe it's around the corner. Finally, I've been waiting years. But maybe now they're getting disappointed that this recovery isn't taking place. You know, and it was pretty interesting watching all the financial talking heads trying to figure out why the price of gold was rallying so much this week. After all, they were trying to blame the sell-off on the market on tapering. But if people were thinking the Fed was going to take away this punch bowl, well, then why didn't gold go down? Now, you know, they were coming up with all sorts of reasons. They were blaming it on Japan. They were blaming it on Egypt. You know, they didn't really want to blame it on the real predicament. One was that they had a bond auction, and that came out with some of the weakest demand, the most recent Treasury bond auction since, I think, March of 2009. In addition, just this week, we got more data that confirmed that private investors abroad from places like China, Hong Kong, you know, they're selling treasuries. Well, if private investors are selling treasuries and the government's going to buy fewer treasuries, well, what does that mean is going to happen to the market? But that also means demand for dollar is going down. If foreigners don't want to buy treasuries, they don't need dollars. So the dollar was down. So you have a weakening dollar, you have falling bonds. That is a positive environment for gold. I think that's more about what gold is keying off of, the weakness in the dollar, the weakness in the bond market, and the predicament that the Fed is in because the economy is relapsing back into recession. Now, even if they tapering is just a down payment on future QE. So even if you believe there's going to be tapering, you want to buy gold because they're going to print more money because they're going to immediately be back in recession. Now, if they never taper and they just keep on doing more and more QE, well, then, of course, gold's going to go up. So I think it goes up either way. Meanwhile, gold is already sold off on anticipation of a taper. So it's buy the rumor, sell the fact. If we actually get the taper that gold anticipated, it's going to rally. But if we never get the taper and it's sold off on the anticipation of something that doesn't even happen, then it rallies even more. But of course, in the end, it doesn't even matter because I know what the Fed's going to do. They're going to do the only thing they know how to do. They're going to print money. They're going to monetize debt because this economy is going to implode. The phony recovery that they created is completely dependent on the stimulus that they're now threatening to withdraw. And again, all they're talking about doing is easing off the gas. They're not even talking about stepping on the brake, which is something that they have to do. But that, I mean, they're not even talking that. They're just talking about slightly easing up on the gas pedal. But you know what? That's more than we can take. We are so addicted. This economy is so dependent, not just on QE, but on ever larger doses of QE. Just like any other drug addict, you build up a tolerance. You can't keep getting the same high on the same amount of the drug. You need more and more drugs to stay high. And in our case, we need more and more drugs, and we can't even get as high as we used to be. That's how big the tolerance is, how much the effects are wearing off. And then eventually, it's not going to work at all. It's not going to matter because the Fed's going to print and interest rates are going to rise anyway because the bonds are going to tank, the dollar is going to tank, and then gold's going to really take off. Has that environment already begun? Was this the beginning of it this week? I mean, it certainly might be because all the ducks are lining up, right? You've got weak dollar, weak bonds, weak stocks, gold going up, silver going up, oil going up. If we see this type of market action repeating itself, if we see more follow through next week, we'll have more of an indication that we are at the beginning of the end game. That's all for now. Again, don't forget to keep listening to the day-by-day coverage of what's going on in the markets and around the world at my radio program. Again, I do that show, the Peter Schiff Show, at schiffradio.com 5 days a week from 10 a.m. to noon Eastern time. And you can listen live. And if you can't hear it live because you're at work, you can go anytime because we constantly repeat the most recent 2 hours on a loop, 24 hours. You can hear it whenever you want. And then, of course, if you want to listen to it commercial-free at your leisure, you can always sign up to be a premium member at Schiff Radio. Again, bye for now. Take care.